You've reached a significant milestone, haven't you? After decades of hard work, planning, and diligently putting money aside, retirement is either here or just around the corner. It's supposed to be a time of enjoying the fruits of your labor, pursuing hobbies, spending time with loved ones, perhaps traveling a bit. And for many, it is. But alongside the well-deserved relaxation, a new set of financial questions often begins to surface, sometimes quietly at first, then perhaps a little more insistently. The focus shifts. During your working years, the goal was likely growth, accumulating as much as possible for this very period. Now, the primary concern often becomes something different. How do you make sure that nest egg, the one you've so carefully built, actually lasts for as long as you need it? How do you protect what you have? This transition from the accumulation phase to what financial folks call the decumulation or distribution phase is more than just a change in financial strategy. It's a profound psychological shift as well. Suddenly, the money you have isn't just numbers on a page representing future potential. It's the resource you rely on for your day-to-day living, for your security, for your peace of mind, potentially for the rest of your life. And let's be honest, retirement these days can be a very long time. People are living longer, healthier lives, which is wonderful news, but it also means that retirement savings might need to stretch for 20, 30, or even more years. That's a long horizon, and it brings unique challenges into sharp focus. One of the biggest specters haunting retirees is inflation. Even seemingly low inflation, say 2 or 3% a year, can significantly erode the purchasing power of your savings over decades. What seems like a comfortable sum today might feel much tighter 10 or 20 years down the line if your money isn't at least keeping pace. Think about the cost of groceries, utilities, or healthcare compared to 10 or 20 years ago. That same gentle upward creep continues, and your financial plan needs to account for it. Just keeping your money under the mattress, figuratively speaking, means it's slowly losing value year after year. So, preservation can't mean stagnation. It needs to incorporate strategies to combat this silent erosion. Then there's the reality of market volatility. The stock market, while a powerful engine for growth over the long term, can experience significant ups and downs in the short term. When you were younger and saving, a market downturn was often seen as a buying opportunity. You had time on your side. You could wait for the recovery. But when you're relying on your investments for income, a sharp drop can be genuinely frightening. Selling assets during a downturn to cover living expenses can lock in losses and permanently deplete your capital, making it much harder to recover. This fear of loss often becomes much more pronounced in retirement. The desire to protect the principal, the core amount you've saved, understandably takes precedence over chasing high returns. It's about security, predictability, and sleeping well at night. Healthcare costs are another major uncertainty. While Medicare provides a crucial safety net, it doesn't cover everything, and supplemental insurance, deductibles, co-pays, and potential long-term care needs can represent significant, often unpredictable, expenses. Having accessible funds without jeopardizing your long-term financial stability is a key part of feeling secure. You want the assurance that if an unexpected health issue arises, you have the resources to handle it without derailing your entire retirement plan. Perhaps you feel this shift keenly. Maybe you find yourself checking your account balances more often than you used to, feeling a knot in your stomach when the market news is negative. Perhaps you worry about becoming a burden on your children or about maintaining your independence for as long as possible. Maybe you have dreams of leaving a little something behind for your family or a favorite charity, but your primary responsibility, is ensuring your own needs are met first. These feelings, these worries, are incredibly common. You are absolutely not alone in navigating this new landscape. It's a natural consequence of moving from earning a regular paycheck to relying on the resources you've accumulated. The sense of responsibility can feel immense. So, when we talk about investment strategies for capital preservation in retirement, what we're really talking about is finding a balance. It's not about eliminating risk entirely. That's virtually impossible if you want to combat inflation and generate any income. Instead, it's about managing risk intelligently. It's about structuring your investments in a way that prioritizes protecting your principal while still allowing for some modest growth or income generation to cover expenses and maintain purchasing power. It's about shifting from a strategy that might have been heavily weighted towards growth stocks to one that incorporates more stable, income-producing assets. Understanding how different investments behave and ensuring your portfolio aligns with your specific needs, your timeline, and crucially, your tolerance for risk in this new phase of life. This isn't about complicated, high-flying financial maneuvers. Often, the most effective strategies are grounded in well-established principles, applied thoughtfully to your unique situation. It's about understanding the tools available and using them wisely. In our discussion, we'll delve deeper into what this looks like in practice. We'll explore the vital role of diversification, why spreading your investments across different types of assets is even more critical now. We'll talk about understanding your own comfort level with risk and how that shapes your choices. We will look at the characteristics of investments often favored for preservation, such as different kinds of bonds, dividend-paying stocks, and perhaps certain types of annuities, understanding their potential benefits and drawbacks. We'll also touch upon the importance of holding some cash reserves for immediate needs and emergencies, and the ongoing necessity of reviewing and adjusting your strategy as your circumstances or the economic environment changes. The goal here is not to make you a financial expert overnight, but to demystify the concept of capital preservation and provide you with a clearer understanding of the approaches you can take. It's about empowering you with knowledge so you can have more confident conversations with financial advisors if you use them, or make more informed decisions on your own. Ultimately, it's about fostering that sense of security and peace of mind that allows you to fully enjoy your well-earned retirement, knowing that you have a thoughtful plan in place to protect the resources you've worked so hard to build. Let's begin exploring how you can navigate this path with greater confidence. Having established why capital preservation becomes such a central theme in retirement, let's now turn our attention to the practical strategies you can employ. Remember, the goal isn't to eliminate risk entirely, as that often means losing ground to inflation. Instead, it's about thoughtfully managing risk, prioritizing the safety of your hard-earned principal, while still allowing for the potential for modest growth or income generation necessary to sustain your lifestyle over the long term. Think of it as building a sturdy financial house for your retirement years, one that can withstand the inevitable economic weather while keeping you comfortable inside. So, what are the core building blocks of such a strategy? First and foremost is the principle of diversification, perhaps even more critical now than during your accumulation years. You've likely heard the term often, the old adage, "Don't put all your eggs in one basket." In retirement, this isn't just good advice, it's fundamental. When you're relying on your portfolio, a significant loss in one area can be devastating if that's where most of your money is concentrated. Diversification aims to smooth out the ride by spreading your investments across various asset classes that tend to behave differently under different market conditions. When one area might be struggling, another might be holding steady or even performing well, helping to cushion the overall impact on your portfolio's value. But diversification in retirement often needs a more nuanced approach than simply splitting money between generic stocks and bonds. Consider the bond portion, often seen as the anchor of a preservation strategy. Within bonds, there's a whole spectrum. You have ultra-safe U.S. Treasury bonds, backed by the full faith and credit of the government. Then there are municipal bonds, issued by state and local governments, which often offer tax advantages, particularly attractive if your investments are in a taxable account. Corporate bonds, issued by companies, typically offer higher interest rates, yields, than government bonds, but come with more credit risk, the risk the company might struggle to repay. You also need to consider the duration of the bonds. Short-term bonds are less sensitive to interest rate changes, but offer lower yields, while long-term bonds offer higher yields, but their value can fluctuate more significantly if interest rates rise. Many retirees find a blend, perhaps focusing on high-quality, short to intermediate-term bonds, provides a good balance of safety and income. Think of someone like Arthur, a retired engineer. He was heavily invested in long-term bonds thinking they were safe. But when interest rates unexpectedly climbed, the market value of his bond holdings dropped significantly, causing him considerable stress, even though he didn't need to sell immediately. Diversifying across different bond types and maturities could have lessened that impact. Similarly, within the stock or equity portion of your portfolio, the focus often shifts. While high-growth stocks might have powered your portfolio during your career, in retirement, the emphasis frequently moves towards stability and income. This often means favoring large, established companies, often called blue-chip stocks, with strong financial health and a long history of paying and ideally increasing their dividends. These dividends can provide a valuable stream of income, reducing the need to sell shares to cover expenses. You might also consider diversifying geographically, holding some international stocks, as different economies move at different paces. However, the overall percentage allocated to stocks will likely be lower than in your pre-retirement years, reflecting the increased focus on preservation. Imagine Sarah, a retired teacher. She kept a significant portion of her savings in the stock of her former employer. When that company faced unexpected difficulties, her retirement savings took a major hit. Diversifying across various sectors and companies, even focusing on dividend payers, would have protected her from such a concentrated loss. It's not just about different asset classes, stocks, bonds, cash, but also diversifying within those classes. Some advisors might even suggest very small allocations to other areas like real estate investment trusts, REITs, which own income-producing properties, or perhaps even commodities. But these require careful consideration of their specific risks and complexities and should only form a small part, if any, of a preservation-focused strategy. The second key strategy involves truly understanding and managing your personal risk tolerance. This is deeply intertwined with diversification and asset allocation. Your risk tolerance isn't just about how much risk you can afford to take, your risk capacity based on your financial situation, but also how much risk you feel comfortable taking, your emotional tolerance. In retirement, these two aspects often converge. Your capacity for loss might be lower because you don't have decades of future earnings to make up for significant downturns. Simultaneously, your emotional tolerance for volatility often decreases. Seeing your nest egg shrink, even temporarily, can be far more distressing when it's your primary source of support. How do you gauge this? Think honestly about how you've reacted to market downturns in the past. Did you lose sleep? Did you feel an urge to sell everything? Consider the sleep test. Can you sleep soundly at night with your current investment mix? How much of your portfolio's value could you stand to see decline in a bad year without panicking? Also, consider your time horizon. While retirement can be long, if you anticipate needing significant funds for a specific goal in the next few years, that money should likely be in very low-risk investments. Your reliance on the portfolio for income is another factor. If your pensions and Social Security cover most expenses, you might tolerate a bit more risk than someone relying heavily on investment withdrawals. It's a very personal equation. Bill and Mary, neighbors and both retired, illustrate this. They had similar-sized portfolios. Bill, having experienced several market cycles and with a solid pension, felt comfortable keeping around 50% of his investments in stocks for long-term growth and inflation protection. Mary, however, relied more heavily on her savings for income and felt much more anxious about market swings. She opted for a more conservative allocation, perhaps 30% in stocks, and a larger portion in bonds and cash equivalents. Neither approach is inherently right or wrong. They reflect different, valid risk tolerances. Aligning your investments with your genuine comfort level is crucial for sticking with your plan, especially during turbulent times. Being too aggressive can lead to panic selling at the worst possible moment, while being overly conservative can lead your savings to be stealthily eroded by inflation over time. Third, let's talk about focusing on income generation from your portfolio. While preserving the principal is paramount, many retirees also need their investments to produce regular income to supplement Social Security, pensions, or other sources. This shifts the investment focus somewhat from purely seeking capital appreciation, growth in value, to generating a steady stream of cash flow. As mentioned earlier, dividend-paying stocks are a popular tool here. Look for companies with a solid track record of not just paying, but potentially increasing dividends over time. These are often mature, stable businesses in sectors like utilities, consumer staples, or healthcare. The dividends can provide spendable cash without you needing to sell the underlying shares. Bonds, of course, are the traditional income-generating asset. The interest payments, coupons, from bonds provide a predictable income stream. One strategy some retirees use is a bond ladder. This involves buying bonds with different maturity dates, say one maturing in 1 year, another in 2 years, and so on, perhaps up to 5 or 10 years. As each bond matures, you get your principal back, which you can then either spend or reinvest, perhaps in a new bond at the long end of the ladder. This provides regular liquidity and can help manage interest rate risk. Different types of bonds offer different yields. Generally, higher yields come with higher risk, either credit risk or interest rate risk, so finding the right balance for your income needs and risk tolerance is key. Beyond stocks and bonds, some retirees explore annuities, particularly immediate fixed annuities. In essence, you give an insurance company a lump sum of money, and in return, they promise to pay you a fixed amount regularly, usually monthly, for a set period or for the rest of your life. This can provide a very predictable, pension-like income stream. However, annuities can be complex products with various features, fees, and surrender charges. Variable annuities, for instance, have investment components and their payouts can fluctuate. It's absolutely crucial to fully understand the specific type of annuity, its costs, the financial strength of the insurance company issuing it, and how it fits into your overall plans before committing. For some, the security of a guaranteed income stream is appealing. For others, the lack of flexibility or the fees are drawbacks. Consider Joan, who wanted absolute certainty about her income. She used a portion of her savings to buy an immediate annuity that guaranteed her a monthly payment for life, supplementing her Social Security. This gave her immense peace of mind, even though she knew she was giving up potential growth on that portion of her capital. Fourth, never underestimate the importance of holding sufficient cash and liquid reserves. This might seem counterintuitive when we're talking about investing, but having readily accessible cash is a cornerstone of capital preservation in retirement. Why? It serves multiple purposes. It's your emergency fund for those unexpected expenses: the car breakdown, the urgent home repair, the sudden medical bill. Having cash on hand means you don't have to sell investments, potentially at an inopportune time, like during a market dip, to cover these costs. It also provides liquidity for your near-term planned expenses, perhaps covering the next year or two of anticipated withdrawals for living costs. Knowing you have this buffer can significantly reduce anxiety about short-term market fluctuations. How much cash is enough? There's no single right answer, as it depends heavily on your individual circumstances, your monthly expenses, the reliability of your other income sources, your health, and your overall risk tolerance. A common guideline is to hold anywhere from 1 to 3 years' worth of essential living expenses that aren't covered by guaranteed income like pensions or Social Security in safe, easily accessible accounts like high-yield savings accounts or money market funds. These won't earn much, especially after inflation, but their primary role isn't growth, it's safety and accessibility. Having this cushion allows the rest of your portfolio, the portion invested for longer-term income and growth, to weather market volatility without forcing your hand. The pitfall, of course, is holding too much cash for too long, as inflation will steadily erode its purchasing power. It's about finding that right balance between safety and the need for your money to work for you. Finally, a successful capital preservation strategy is not static. It requires regular review and rebalancing. Your life isn't static, and neither are the financial markets. What seemed like the perfect plan 5 years ago might need adjustments today. Perhaps your spending needs have changed, your health situation has evolved, or market returns have caused your carefully planned asset allocation to drift significantly. For instance, if stocks have had a strong run, they might now represent a much larger percentage of your portfolio than you initially intended, subtly increasing your overall risk level. Rebalancing is the process of periodically bringing your portfolio back to its original target allocation. This typically involves selling some of the assets that have performed well, selling high, and buying more of the assets that have underperformed or lagged, buying low. While it might feel counterintuitive to sell your winners and buy laggards, rebalancing enforces discipline and helps manage risk. It prevents one asset class from dominating your portfolio and ensures your investment mix stays aligned with your risk tolerance and goals. How often should you review and rebalance? Many people do it annually, perhaps around tax time or on their birthday. Others might do it when their allocations drift beyond a predetermined threshold, say 5% or 10% away from the target. A regular review, perhaps with a trusted financial advisor if you use one, also provides an opportunity to reassess if your overall strategy still makes sense for your current situation and outlook. Life changes, and your financial plan should adapt accordingly. These strategies, diversification, understanding risk tolerance, focusing on income, maintaining liquidity, and regular review, form the bedrock of preserving capital in retirement. They work together, creating a framework designed to provide stability and income, while managing the inherent risks of investing, allowing you to navigate your retirement years with greater financial confidence. So we've journeyed together through this important landscape of capital preservation in retirement. We started by acknowledging that very real shift in perspective that happens when the paychecks stop, and you begin relying on the nest egg you've so carefully nurtured over many years. The focus naturally turns from aggressive growth to ensuring that what you have lasts, providing security and supporting the life you want to live throughout your retirement, however long and wonderful that may be. We recognize the common anxieties around inflation silently eating away at purchasing power, the unsettling bumps of market volatility, the unpredictable costs, especially related to health, and the fundamental desire for independence and peace of mind. It's a transition that demands a different approach to managing your finances, one centered on stewardship and sustainability. In exploring the practical strategies, we delved into the core principles that underpin a sound preservation plan. We emphasized the critical role of diversification, not just as a buzzword, but as a vital technique for managing risk. This means spreading your investments thoughtfully, not only across broad categories like stocks, bonds, and cash, but also within those categories. For bonds, this involves considering different types: government, municipal, corporate, and varying maturities to balance safety, income, and sensitivity to interest rate changes. For stocks, even within a preservation strategy, diversification means not concentrating too heavily in any one company or sector, perhaps favoring stable, dividend-paying companies, and potentially including some international exposure to further spread risk. The aim, always, is to avoid having too many eggs in one basket, ensuring that a downturn in one area doesn't jeopardize your entire financial foundation. We then discussed the deeply personal nature of risk tolerance in retirement. It's about understanding not just the financial capacity you have for risk, but also your emotional comfort level. The sleep test remains a valuable guide, structuring your investments in a way that allows you to feel secure and avoid making panicked decisions during inevitable market turbulence. Recognizing that your tolerance for seeing portfolio values fluctuate likely decreases in retirement is key. Aligning your asset allocation, the mix between potentially higher growth but more volatile assets like stocks and more stable assets like bonds and cash, with your genuine comfort level is paramount for staying the course with your long-term strategy. The conversation naturally led to focusing on income generation as a component of preservation for many retirees. If your portfolio needs to supplement Social Security or pensions, generating income becomes a priority. We looked at how dividend-paying stocks from established companies can provide a regular cash flow without needing to sell the underlying shares. We explored the traditional role of bonds in providing predictable interest payments and discussed strategies like bond laddering to manage risk and provide liquidity. We also touched upon annuities as a potential tool for creating a guaranteed income stream, while stressing the importance of fully understanding their complexities, costs, and suitability before committing. The goal here is to create reliable income streams that support your lifestyle while minimizing the need to sell assets, especially during unfavorable market conditions. Crucially, we highlighted the often underestimated importance of maintaining adequate cash reserves. Holding a buffer of readily accessible funds, perhaps 1 to 3 years' worth of essential expenses not covered by guaranteed income, provides immense psychological comfort and practical flexibility. This cash acts as your emergency fund, preventing the need to liquidate investments at potentially the worst time to cover unexpected costs. It provides the liquidity for near-term planned spending, allowing the invested portion of your portfolio the time it needs to ride out market cycles and work towards your longer-term goals. It's the financial shock absorber that lets the rest of your strategy function effectively. And finally, we underscored that a capital preservation strategy isn't something you set up once and forget. It requires regular review and rebalancing. Life changes, markets fluctuate, and your needs evolve. Periodically checking your portfolio, perhaps annually or when allocations drift significantly, ensures it remains aligned with your goals and risk tolerance. Rebalancing, selling assets that have grown disproportionately large and buying those that have lagged, imposes a helpful discipline, preventing unintended risk concentration and systematically encouraging you to sell high and buy low, even if it feels counterintuitive at times. This ongoing attention keeps your plan relevant and responsive to your life's journey. Now, stepping back from the specific strategies, what does this all really mean for you? It means acknowledging that managing money in retirement is different, and that's okay. It requires a mindset shift, moving from the accumulation race to a focus on stewardship, income, and protection. But this shift doesn't have to be fearful. Instead, view it as entering a new phase where careful planning allows you to reap the rewards of your lifelong efforts. Think of these preservation strategies not as limitations, but as tools that empower you to navigate the future with greater confidence. They are designed to provide stability in an often uncertain world. The process of thinking through these issues, your spending needs, your comfort with risk, your sources of income, your long-term hopes, is itself incredibly valuable. It brings clarity and helps replace vague anxieties with concrete plans. Remember, the goal isn't necessarily to achieve the absolute highest possible return. It's to achieve the return you need to support your retirement lifestyle, while taking the least amount of risk necessary to do so, and crucially, ensuring your capital lasts. It's about finding that sustainable balance that allows you to live comfortably and sleep well. There's a profound sense of security that comes from knowing you have a thoughtful plan in place. It's a plan that acknowledges risks like inflation and market downturns, but has proactive strategies to mitigate them. It's a plan tailored to your specific situation, your needs, and your comfort level. This sense of control, of having thought through the what-ifs and having mechanisms in place, can free up enormous mental and emotional energy. It allows you to focus less on financial worries and more on the things that truly bring joy and meaning to your retirement years: family, friends, hobbies, learning, contributing to your community, or simply relaxing and enjoying the view. Please, don't feel overwhelmed by the details. You don't need to become a financial wizard overnight. The key is understanding the core principles. Whether you manage your investments yourself, work with a trusted financial advisor, or use a combination, this understanding empowers you to ask the right questions, make informed decisions, and feel confident that your strategy aligns with your objectives. If you do work with an advisor, having this knowledge helps you be a more active participant in the management of your future. This journey of capital preservation is fundamentally about ensuring your financial resources support the life you've worked so hard to achieve. It's about making your money work for you in a way that prioritizes safety and sustainability, allowing you to navigate the inevitable ups and downs with resilience. It's about building a financial foundation strong enough to support your dreams and secure enough to provide peace of mind. So, take heart. By embracing these principles, diversification, understanding your risk tolerance, focusing appropriately on income, maintaining liquidity, and committing to regular review, you are taking meaningful steps to protect your financial future. You are building a framework for security that can allow you to truly savor this chapter of your life. Final thought. Remember, careful planning for capital preservation isn't about restricting your life. It's about enabling it. It's the thoughtful preparation that allows you to step forward into your retirement years with confidence, security, and the freedom to enjoy all that lies ahead.